Welcome back, Catching Up to Fi. Last week we entertained the idea of bonds and we began the discussion. It went so long that we had to break it up into 2 episodes. So this week it is part 2 about bonds. What are they? Are they dead? Or are they just in the bear market and cheap? And we should be buying them, especially if we're entering retirement. Well, I really enjoyed this conversation, and I hope you enjoy part 2. If you did not listen to part 1, roll back into last week's episode before continuing here so that you enjoy the progression of the conversation.
When you're accumulating wealth, you're just trying to get a bigger number. At a certain point, hopefully, you'll reach a number that's big enough for you the rest of your life, and you won't have to just keep working and accumulating until you expire. But once you get there, then your goal becomes different, that you're not trying to get the most money, but you're trying to be able to use the most money in most circumstances. If you really want to use a portfolio to live on and have it be stable and survive the next 10 years, you don't want a 100% equity portfolio. And what he found was that the better portfolios for that had somewhere between 40%-ish and 70%-ish in stocks. And then the question is, if that's the stock portion, what's the rest of it?
Welcome to Catching Up to Fi, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to Fi together.
That brings us to sort of bonds across the investing life cycle. Most in our community and with risk tolerances that they have are, 100% equities the first 10, 20, 25 years of your working career, set it and forget it, and then we'll eventually transition. My question to you, however, is not everybody has 100% equity risk tolerance, and growth portfolios tend to be 80 to 100% equities, and they'll operate 90% the same. But some people do want bonds in their portfolio. Target dates have bonds in their portfolio. For young folks, they'll have 90% equities and 10% some sort of fixed income. If somebody doesn't want to be 100% equities, but is considering themselves an accumulator, how would they organize their bond portfolio at a 90-10, 80-20?
You have several options. I think you need to think about, why do you want those bonds? Because that's really what tells you what kind of bonds to buy. Are you holding them because you're worried about a recession? Then you would be holding like intermediate and longer term treasuries. Are you holding them just because you want to have like a cash pile sitting there? Then you'd be holding short duration bonds. And if you, for some reason, wanted to get income out of them, you might be holding some kind of corporate bonds, but that probably doesn't make much sense because of the taxes. The real question always needs to be, why do I want to hold this? Because otherwise you just buy something, and a lot of times you ask people why they're holding it and they don't really know. Because it's not stocks and somebody told me to do it.
It was on sale at Target and it had a pretty cover.
And you get these terrible obsolete advice. Back in the 1990s, somebody invented this idea that maybe it's a good idea to organize your portfolio by your age. So we'll take 100 minus your age, and that's the percentage of stocks you should hold, and then the rest should be in bonds. There's never been any analytical reason for doing that. It literally has never made any sense, but for some reason it became popular. It was one of those things that, like a bad penny, it keeps showing up. It is a litmus test now these days. If you hear somebody saying that, my reaction is that person probably is not somebody you want to be taking advice from, because that advice is obsolete. And anybody that's analyzed it realizes it doesn't make any sense, because your financial life is not necessarily based on your age anyway. So be careful about these kind of hoary chestnuts that you hear about percentage of bonds to hold that aren't really based on your individual circumstances and are based on some metric like somebody's age or something like that.
For me, for example, I didn't have the stomach as a late starter for 100% equities starting at 50. So I was 80 to 85% equities, simple kind of Bogleheads approach. And I had intermediate term treasuries. Initially, I had kind of BND. And people talk about VTSAX and chill and BND and chill. And then you've mentioned long-term treasuries. And now with my new understanding of bonds over the last few years, I would never hold BND in an accumulation portfolio for any kind of recession insurance or whatnot, because as we both know, and you'll tell us, there's a significant percentage of corporate bonds in there, and it's much more highly correlated with the stock market. So how is it insurance against anything?
Well, it's trying to do too many things. And like I say, each kind of bond does one of these things better and the other one's not as well, whether it's diversification or stability or income. And a fund like BND is trying to do all those things, and so ends up just not doing any of them particularly well. And so it's sort of like the symptom that you don't know why you're holding the bonds.
Well, it's because the simple path to wealth told me that I needed to have it, right?
Somebody said I need these. Why did they say that? And there's got to be a better explanation or a better purpose in mind, I think, because what you really want to do is figure out your purpose, and then you would just essentially take the bonds, because BND has all of these things in them. It doesn't have any tips in it, but it has corporate bonds, it has treasury bonds, and they're of all durations from very short to very long. So what you're better off doing is probably holding fewer bonds, but only holding the ones you really want for the purpose that you're trying to serve, is generally the way I tend to look at it. You should always have in the back of your mind, look, these bonds are not going to drive my returns long term. So I need to have a real purpose for holding them that is not returns. It's got to be something else.
Yeah, I mean, if I had it to do again and I couldn't stomach 100% equities, I probably would have held like 10% long-term treasuries for the rebalancing bonus and recession insurance, so to speak, because you do get a little turbo boost from rebalancing into something that's low and other things are high, as we know. So that's what I might have done if I'd have known more about bonds and not just bought the flavor of the day, which was BND.
The better way I always think about accumulation, and people call this your personal capital, your human capital sometimes. I think of it as you're starting out and you know you're going to be investing a certain amount of money basically out of your salary. That salary that's coming in that you're planning on investing, that is just like this big pile of future cash. It's like having a big pile of cash. So if you think about, I'm starting with this 100% present cash and future cash, and I want to build up my equities, the more years you're planning on investing, the bigger this pile of future cash is. And if you think about that, then the amount of equities you're having, I have 100% equities, but it may not be that large compared to what you're planning on investing in the future. And that cash is essentially like the shortest term bond there is really what it's like. So you are, in a sense, diversified in a way you probably don't want, at least for like the first 10 years you get going for most people. They're just building.
Well, actually, you might not be a pile of cash. You might actually be a pile of tips, because as your income goes up, you're kind of got some inflation protection built in. So
you do hope your wages rise quicker than inflation. It doesn't always happen. But
and not have stagflation or stagflation in wages. It's interesting because people talk about human capital being a bond, but in reality, it's not. It is cash, or if it is a bond, it's more like a tips.
It's a future cash stream is what it is.
All right. Well, we've got to address transition and decumulation and the retirement goal, because that's when things really change. And that's where all this comes into play with regards to correlation, diversification, wealth preservation versus accumulation or growth. And we've had other episodes on this, but bonds play a critical role in transitioning to a more stable portfolio that will not sustain equity volatility or equity drawdowns because of the role it plays in the mix of the four quadrants, right?
Yeah. Obviously, when you're accumulating wealth, you're just trying to get a bigger number. At a certain point, hopefully, you'll reach a number that's big enough for you the rest of your life, and you won't have to just keep working and accumulating until you expire. But once you get there, then your goal becomes different, that you're not trying to get the most money, but you're trying to be able to use the most money in most circumstances. At least that's what Bill Bengen's research was all about. It's like, how can I get the most use out of this money? And he expressed it as a safe withdrawal rate, but that's related to all of these kind of efficiency metrics. And those guidelines that he first came up with 30 years ago, and he's recently put back and reaffirmed it in his recent book, basically tell you that if you really want to use a portfolio to live on and have it be stable and survive the next 10 years, you don't want a 100% equity portfolio. And what he found was that the better portfolios for that had somewhere between 40%-ish and 70%-ish in stocks. And then the question is, if that's the stock portion, what's the rest of it? That was commonly bonds, could be cash, could be other things, but bonds do fill a role then as part of that not stock portion of the portfolio. And so he's basically found a couple other things. One of them being if you hold too much in short-term bonds or cash, that also detracts from your ability to spend over time. And the number he came up with was 10% because he was using T-bills to model that. So you don't want too many short-term bonds or cash, but that puts a limit on that. And then the other question is, if you're holding these bonds, what are you holding them for? The reason most people are holding them is I'm worried my stocks are going to go down. So let's think about, when do stocks go down? Stocks go up 70% of the time after inflation. And if you look at when they go down, half of the time they go down, or 15% of all cases, the reason they're going down is there's a recession. And then the next question is, what do we do about a recession? The best thing to hold in a recession happen to be intermediate and long-term treasury bonds. So those two things can act as recession insurance for that 1 in 7 years that you expect to have recessionary environments, which tells you you want to have some insurance for recessions, but it's only going to happen 1 out of 7 years. So you don't want to have too much of this kind of insurance. And then the only other question is, what else would you be doing with bonds in a portfolio? And then it's hard to justify them for other purposes because they certainly do not fight inflation. I know it's a common misunderstanding that holding a TIPS fund is going to protect your portfolio from inflation. It doesn't. We saw that in 2022.
Well, tell us the 2022 story, because you have an interesting history with TIPS, because the great Uncle Frank, Wizard of Oz Vasquez, has made mistakes, and one of them involved TIPS. So take us through your own little TIPS history and why you dug into it and realized that they don't perform the way you thought they performed and didn't really find a role for them in your portfolio, for example.
Yeah, this was all the way back in 2008, actually, when I was trying to figure out, my investing history goes back to the 1990s. In the 1990s, we were all told to go chase the next Peter Lynch and find the best fund manager. That era died with the dot-com crash. Then the rage in the first decade of the 2000s, if there was a rage, that was when indexing really became popular. And people started really using index. Let's not chase fund managers. Let's just use index funds. And TIPS were very new at that time. And there was I remember reading this book called Spend Till the End. It was written by Lawrence Kotlikoff and Scott Burns, published in 2005. And I thought that this was going to be what told me what to do.
So that was the shiny object for you back then, huh?
So it said, all right, you can have a simple index portfolio and you just have a total stock market fund and a total international fund, and then just make all your bonds TIPS, because we have these new things that are called TIPS, and they're going to protect you both for inflation and for recessions. And so when I was going into 2008, I was like, all right, I made almost all my bonds TIPS at that time, bought a TIPS fund. I was sorely disappointed in late 2008 when this TIPS bond fund went down 10%. I thought this was the thing that was going to help.
Wait a minute.
Wait a minute. That's not what was advertised here. And what was really infuriating about it, because at the same time, nominal treasury bonds were going up in value. And I was like, I wanted that one.
What was the spread at that time between your loss of 10% and how much did treasury bonds go up?
They were up like 20%. It was like 30.
Wow.
It was a traumatic experience, Bill. That's why I still remember this to this day. And it's interesting. There are a lot of people who don't realize that happened, or you ask them and they remember it differently. They remember that TIPS were a great thing to hold in the 2008 crisis. I don't know what you were doing then, but let me tell you what actually happened to me.
Yeah, I mean, people think of flights to safety, and the flight to safety really is to long-term and intermediate-term treasuries, and TIPS did not perform that function of a flight to safety at that time.
No, they didn't. And then, so that was the recession part of it. And then people would say, oh, yeah. Maybe not the recession, but when inflation comes, that's what you got to hold. That's what you got to hold. And 2022 comes around, and if you look at your average TIPS bond fund, it performed worse than the average nominal bond fund. And the reason that is because these are still bonds. Bonds are never going to save a portfolio in an inflationary environment. That's just not what they do. They're not built for that. And so the only thing TIPS will do for you in terms of inflation is when you're comparing TIPS to either nominal bonds or cash during inflation, you're worried about your cash not keeping up with inflation. So a very short-term TIPS fund like VTIP will keep up with inflation in that kind of environment. But if you're looking at longer-term TIPS funds, they're really not helping you much at all. And in fact, they're oftentimes making things worse. So the idea that they are going to save you or save your portfolio from inflation it's just not correct. They don't do that.
Well, they're trying to do two things with one product, right? Inflation hedging and recession insurance. And you got to pick an ingredient for your portfolio cake that does the job you want it to do.
Yeah. They're trying to do two jobs they're really not suited for protecting a portfolio from inflation. And so they can't do that. And so you would want them to at least perform really well in 2008, and they didn't do that either. I'll use something else instead of that. It becomes like this wasted space in your portfolio. It's like I could put some value stocks in there that'll do well in an inflationary environment or something else in there. And then if I want my recession insurance, I'll use the best bonds for that and only those and not too many of them. So we're not holding like 40% in bonds because we want to hold all the bonds in the world. We're holding more like 20% in bonds. And so we can allocate the rest of the portfolio to other things. That just ends up being good portfolio construction. I think people try to use bonds for too many things and say, well, these are different, so they must perform different or perform a different function. When in the end, all bonds are bonds and they have certain characteristics that are common to all bonds. And one of them is they're not going to save your portfolio from inflation. TIPS will save the amount of cash you'd invested in there versus holding it in cash or a nominal bond, but that's not a panacea for the rest of your portfolio.
Yeah, and we've also got to address the elephant in the room, that ever-present TIPS ladder to infinity that has become popularized by certain gurus out in the world. And they can do it because they may be oversaved, but you have an opinion about these TIPS ladders that are becoming popularized now.
Yeah, well, I agree with what Michael Kitts has said about these things, which is if you can afford to do that, you are probably just well oversaved and you could hold 100% stocks or whatever you wanted to do. A long-term TIPS ladder is a complicated thing to create. I'm talking about like a 30-year TIPS ladder. You have to buy equal amount of TIPS to cover all the years. Usually you can't do that, so you need to do some fudge factors. It causes a lot of problems tax-wise because TIPS also have this kind of phantom income, which is difficult to explain, but it basically causes you to have more taxes to deal with. And then the problem is, what if you live longer than 30 years? Then what happens? The main idea of why you would use a bond ladder, and these do work well if you're just doing some kind of intermediate term ladder. Say, I'm going to take Social Security in 6 years. I have this gap. I'll put a bond ladder in there. And so it's 1 to 6. And then each year I will get the interest from the bonds and I'll also get the principal back, 1/6 of the principal back every year. And I'm going to spend that. That is the good use of a bond ladder. If you're just holding it and recycling it, you might as well have a bond fund. And if you're trying to do a 30-year ladder thinking, you don't know when you're going to die. If you did know when you were going to die, then, I'm going to make this a 28.6-year ladder because I'm planning on dying in 28.6 years. But the problem is not knowing when you're going to die. It just creates this huge inefficiency. Either you die earlier and then your heir gets this stupid TIPS ladder when they would have much prefer to have a nice pile of equities that they're getting a stepped up basis on and they're not getting taxed on, or you run out and then what are you doing then? It's almost like a flex, I would say, that people who like to spend money will take their extra money and go buy a Ferrari. People that want to hoard their money will take that money and not buy a Ferrari. They'll go buy a tips ladder. And then they'll show all their friends, oh, look at this thing. It's big. It's going to last me for the next 30 years. It moves, it shakes, it dances at the disco. The reality is that it's not a very efficient thing to use. There's almost always a better option. That was Michael Kitz's opinion when this first became popular. And I agreed with that opinion, that the use case of this is so small that it's not worth doing.
Do we have the single ETF yet that incorporates a 30-year tips ladder so that we can buy one fund and do it?
There might be one out there. I don't know. There are all kinds of funds now that mimic bonds ending at certain dates. And there are more and more of these things coming out all the time. I'm not aware of one, but that would cause a different problem, because the whole idea of a ladder is you're not only getting the interest, you're getting your principal back in these annual increments so you can spend that principal. If you have one of these interval funds or whatever they are these days, they have a whole bunch of different names too, because they get marketed heavily. That if you're not getting the principal back to spend, then it's just like another bond fund if it's just being reinvested over and over again. Because that's what a bond fund is. It's an endless ladder that they just keep taking the lower ones or the lower maturity ones and then putting them back on the top to keep a steady maturity in a bond fund. So everybody I know that has a tips ladder is like grossly oversaved.
And you brought up the point,
3 times as much money as they could ever need or want, or anybody would ever want. So it's like, all right, there's your Ferrari.
An interesting analogy. You bring up a good point about the bond ladder phenomenon and mental accounting that goes into it, because this is something that's often heavily marketed by AUM, assets under management advisors, with 1% assets under management fee, give or take. And in order to protect people from equity risk, they'll create a cash bucket of, say, 2 or 3 years. And that's where your 10% allocation to cash comes in, because that's about 2.5 years of cash. More than that, and you're going to have cash drag. And then they'll have, say, years 3 to 8 are, bonds maturing at those dates for your cash flows. They call it asset liability matching or time segmentation. And on the back end of that, the third component, and sometimes a fourth, is 1 or 2 different quote unquote growth portfolios that have equities of different, say, market cycle lengths so that they can tolerate. And so there may be 1, 2, 3, 4, 5 segments, buckets, and ladders in here that makes a portfolio construction sound really complicated that only an advisor can do it for you. What are your comments on, and you agree with Ben Carlson here, the implementation of a bond ladder and its psychological effects that have no different mathematical effect because people don't necessarily understand what they've bought?
Yeah, there are several things going on here. This kind of structure is very psychologically attractive. So it's easy to market, particularly when you think about the kinds of people that typically go to retail financial advisors. The reason they're going to a retail financial advisor is they don't know anything. And this presentation is very psychologically attractive, that we're taking care of you, because what people are mostly worried about is the near future. They're not thinking about, they're thinking about their next 3 or 5 years and not even their next decade. But it turns out to be very inefficient and requires a lot more work. And I guess it gives advisors something to do. But the truth is, rearranging, I always like to say, rearranging the lollipops on the good ship lollipop doesn't make them taste any better. You could put the cherry ones in a row and then the purple ones in a row. But the fact of the matter is, most of these portfolios ultimately end up, it's just a 60-40 portfolio in a different guise. So what do you think about? I have sort of 10 years of bonds lined up. and then the rest of it. And it does not change the overall performance other than making the management of it much more complicated, because you need all sorts of different rules about which asset am I taking at which time. And if stocks go up, do I take from the stocks or do I take from these short-term ones? And then do I reinvest the short-term ones in the intermediate ones? And the more buckets you have, the more rules you need to manage them. And it becomes very cumbersome and oftentimes inefficient. And it does lead to holding things like just too many bonds overall, or too many short-term bonds, as Bill Bengen has told us over and over again. Don't hold more than 10% in those if you want a good portfolio. The alternative is much simpler, which is just, it's the total return approach. And you just hold a diversified portfolio, and then you look at it and either you just sell the highest thing, or when you rebalance it once a year, you create what Harold Evensky, when he originally invented a bucket strategy, all that really was, it wasn't all these 3 buckets in these 10 years and all that sort of stuff. All it was, let's at rebalancing time make a pot of cash, and we'll just spend that cash for the whole next year or 6 months. And that way we don't have to look at the portfolio, and you won't get nervous about it because you have this pile of cash. And that was the whole idea. And so you can do that with a total return approach. You really don't need all of these and ladders to do this, even though it is psychologically attractive. And that is often why it's used, why it's sold, and why it's presented that way. Because
I mean, the point that I really brought it home for me was, if you create the 8 or 10 year bond ladder set, you've basically direct indexed in treasuries, like if you direct indexed in stocks, and you've created your own duration.
Your own bond fund.
Exactly, and you can call it my bucket fund. But and the total return approach that we may advocate, which is good for some people and not others, is really a bucket strategy in its own right. Really. It's multiple streams of income that some are performing and some aren't, and you take from the high and buy the low and create your cash bucket from your returns, your streams of income, which are the different assets in a total return portfolio, whether it be you can add housing to it in real estate or small business, but functionally in a diversified portfolio, you are creating a multi-legged stool that's all going towards filling your bucket of cash.
Yeah, and the overall performance of a portfolio does not change based on what order you put things in or how you arrange them. It will perform, if it is a 60-40 portfolio, it's going to perform like other 60-40 portfolios with whatever stocks and bonds in them that you already have. The only difference is going to be, it's going to be more complicated to manage if you force them into this rigid ladder or bucket configuration, which will give an advisor a lot more to do. I have some of my listeners have come to me with very horrible looking things and asking me, how do I get out of this? Or what do I do with this thing? Because unfortunately, some of them got put in, they have all these individual corporate bonds and all sorts of other things like that. Is when are these things expiring? So we just get them out. We don't need 10 different bond things. We can have 2, and that'll be a lot simpler. Ultimately, it has more to do with the business model of financial advisors and the marketing of financial advisors to the people that they serve, because it's an attractive thing to present. And it works well for obviously they're doing something complicated, so you better keep hiring them to keep doing it. Because
different flavors for different folks, but it doesn't necessarily, like you say, the lollipops aren't necessarily going to taste differently. The thing that is prevalent in today's FIRE population and movement, it seems to me, and this is anecdotally, is sort of a barbell approach to diversification and portfolio management. They've been 100% equities riding the big bull market up. And the concept of diversification really means, okay, I'm going to create a 2 to 3 year pile of cash, because I will have 80, 85, 90% stocks and this 3 year pile of cash, and I'm fine. What do you think about that approach, and what are the dangers involved in that? And what would you tell this typical sort of firee that's just only seen a bull market?
The good news is you only need to be lucky. The issue here is this. What that is thinking about is that is set up as if the risk that you're facing is a short downturn, like a 2022. It's only like 1 to 3 years. It's only as long as your cash is there. And oftentimes you hear somebody say, an average downturn is only 2 to 3 years. Therefore, I'll just have 2 to 3 years of cash and I'll be able to survive an average downturn. The problem is the risk you're facing is not an average downturn. The risk you're facing is a bad decade. It's a decade like the 1970s or the early 2000s. So that is what you're really protecting against. And that is what, if you talk to Bill Bengen or Michael Kitces, they will all say that the real sort of inflection point is if you construct a portfolio that is going to be good for 10 years at whatever rate you're spending out of it, you're going to be pretty much good to go after that. Because either the market's going to turn around and go up, even if you had a bad 10 years, or in most cases, you won't have the worst 10 years. And so you'll have more than you started with, and you'll be able to manage it very easily from there. But you really need to be thinking about what kind of portfolio is going to help me survive a bad decade, and make sure that you actually do a stress test of what if I retired in 1999 or in 1968? What would have happened with this portfolio and whatever I plan to spend out of it? And that is the way a good advisor will approach this, that they'll not only do sort of standard Monte Carlos, but they'll also do stress tests for the worst start dates that you could possibly have historically. And if you look at how the portfolios you're describing performed under those stress tests, it's not pretty. It's very ugly. And if you retired in 1999 and were trying to spend 4% out of an 85% stock portfolio with 15% in short-term bonds or cash or something like that, you may be out of money by now. That's the truth of it. Fortunately, those bad decades, you don't start in a bad decade most of the time. And even people that started in the middle of that decade were fine if they landed their stuff through the 2008 crash. But that is really the statistic that always jumps out at me for safe withdrawal rates in any kind of retirement planning. It's what you are planning for is a bad decade, that first decade. And so if you are planning for something else, you're probably not planning for the right thing, or you're just planning on being lucky. Fortunately, people have been lucky, but that's why this kind of portfolio is favored right now, because it's a recency bias. And this is true of pretty much any era, because if you go back to the late 1980s, when the very first fire books were coming out, I have a book on my shelf published in 1988 called How to Retire at Age 35. And Vicki Robin's book came out soon after that. What they recommended at that time was to hold CDs, because CDs at that time were paying 8%. And you could get like a 5-year CD and then roll them over. But that didn't last forever. And the people that wrote that book that I told you about, the Tour Horse, did ultimately have to shift their money into equities. So I think the reason that particular portfolio is popular now is just out of recency bias, because obviously any kind of stock portfolio you've bought since the great financial crisis has done great guns bonkers, and you don't have any problems at all. And so I can understand why people think that's all they need.
It's interesting you bring up Vicki Robin, and we talked about that before the show, because people don't know necessarily how Vicki Robin became financially independent. And it wasn't riding an equity bull market up the cliff, was it? It was more in fixed income, equities, real estate, and private investing. It was a bond, fixed income centric type style or approach back then, right?
Yeah, because interest rates were really high. That was the bond bull market, which did affect all kinds of fixed income instruments all through the 1980s, starting with interest rates you were getting like 70% in a money market fund in 1981. And of course, that was the death of equities, as was published on Business Week around that time, because stocks have performed horribly for the last 12, 14 years for the most part. And so everybody was all gung-ho about all of these debt instruments. And lots of people, that's what they held throughout the 1980s. And Unfortunately, most of them held short-term ones. They were worried about the long-term ones. What you really wanted to buy in 1980 or 1981 was long-term treasury bonds, actually, because you would have outperformed the stock market for the next 20 years.
Yeah, I mean, that's an important statement to make. Bonds do at times in certain eras, certain weathers, outperform stocks. People can't imagine that, I think, today, right?
No, but when interest rates move that much, I think the main lesson is you don't know what's going to happen. So try to create a portfolio that is going to perform adequately in whatever environment you might think you're likely to be in. And we know what those environments are. We've seen them before. I mean, history doesn't repeat, but it rhymes. So.
I mean, this has been a great discussion today. It's really been a comprehensive talk about bond investing, life, and we have made it through this entire show without saying the words risk parity.
How dare you?
People think that Frank's going to be on the show and, oh boy, it's going to be about risk parity again. Here we go. This is a component of it, but I think we've made a good case for having portfolios with purpose designed in mind, goals, and looking at assets and asset classes as not just being a flavor of the month, but this is what I needed to do in my portfolio for my longevity. Because when you say a bad decade, we're talking about not just globally, but like an asset class, like the S&P 500 is flat for a decade. Well, if you're all invested in S&P 500, well, you're flat. But if you have other things, they're doing well.
You're not only flat, if you're taking money out of it, you're just watching your balance go down.
I mean, countries have a bad decade. Japan had 3 bad decades back to back, which we don't talk about because it didn't affect us. The bad decade isn't kind of a global market bad decade. It affects certain asset classes more than others. And then a diversified portfolio like risk parity will have components of the portfolio that operate better than others or less worse than others in that time period too, right?
Yeah, all risk parity method of diversification. It's the same. It's applying Markowitz principles. It's not really that different from other things. It's just really focusing on that qualification, diversification being the most important thing to look at first, and really looking at all of the assets in the portfolio and seeing how they all interrelate with each other, as opposed to just saying, I got this pile of stocks over here and I got this pile of bonds over here. And you're not really looking at the interrelationships between all of the assets together.
And the important thing is, too, we're not basing this on feelings or how things look or how they sound different. This is data-backed stuff with a historical back testing, Monte Carlo prospective testing, and we have sites like Portfolio Charts. We have sites like Portfolio Visualizer. We have sites like Testfolio, where this data is all publicly available, and we can take the assets we think will work for us and test them against other standard portfolios. And, you'll be surprised what you see when you do this. And when you look at how they invested 30 years ago, as opposed to how you can invest now, that may be a little different and more what we call fourth level thinking or investing on the cutting edge of financial technology in this golden age, as you talk about it, of investing. So we're here to encourage people to look at all asset classes. You can't put everything in the cake. And it is also simple. It's not as complex as people think. The term risk parity is like a big turnoff. I don't want to hear about it again. Let me hear about the 3-fund portfolio or the 1-fund portfolio. But we're trying to, I think, in the end, just educate people that as long as it's a logical process and you have a 4-stage process for your portfolio construction, and that may be a good way to end. So this is the process we want people to go through when they're thinking about diversifying in retirement. What 4 things do you recommend people think of?
I have many lists of 4 things, Bill. Some of them not appropriate for this venue.
What would be the appropriate clip at this point? I have to think about that.
So in terms of principles, the main first 3 principles are, one of them is called the Holy Grail principle, which is basically Ray Dalio's statement of diversification that, at least in the complex portfolios he was describing, he was trying to get up to 15 assets that were uncorrelated, or basically get as many assets that are uncorrelated and put them together in a portfolio, because the more diversification you have, the more benefit you're going to get out of it. I don't think you need 15 different things. I think you can go with 3, 4, or 5. But that diversification principle is the bedrock principle, and looking at how each fund or asset you're going to put into this portfolio does go. You can put all the assets or funds you wanted to put in there and go over to Testfolio and look at a little correlation matrix and see how they all relate to each other, just to see whether they are actually diversified from each other as much as you think they are. The second principle is called the macro allocation principle, and that comes from Common Sense Investing, Jack Bogle's great book, chapters 18 and 19. And he just observed that if you look at a whole bunch of fund managers who are all managing different kinds of portfolios, what he found was that you could really categorize them by their macro allocation. So all the fund managers that were trying to create 80-20 portfolios were all about the same. If it was 80% stocks and 20% bonds, at least in terms of long-term returns. And so what that gets at is really, you do need to be thinking of the big picture before you start looking at different bond funds or different stock funds. Just how much do I want in stocks in this portfolio? How much do I want in bonds? How much do I want in cash? And how much do I want in whatever else I'm putting in here? And so that idea that one of the key factors in just looking at a bunch of portfolios, if you tell me one's an 80-20 and one's a 60-40, I can tell you which ones is going to be more volatile. I can tell you which one's going to have a higher return profile over a long period of time, just based on that. That's a key factor. And don't expect you can really change the performance of a portfolio simply by putting more and more stock funds in a portfolio if the total amount is the same. That having 2 stock funds or 3 stock funds or 4 stock funds is probably just as good as having 10 in terms of, because it's the overall percentage that matters the most there. And then the third one is the simplicity principle, but I apply this in Einstein's simplicity principle. Einstein said, make it as simple as possible, but not simpler, which means make it as simple as possible for the purpose you're trying to serve. So if you're trying to create a portfolio that's a good retirement portfolio, your goal should not be to use the fewest funds. Your goal should be to create a good portfolio that works well. And then let's simplify down to the number of funds that we really need to do this. So like I was saying, you probably don't need 10 stock funds. You can have 2, 3, or 4. But you don't want to worship the simplicity God. You don't want to say the best portfolio has 1 fund because it is 1 fund. That's oversimplifying. And that's why it's the third principle and not one of the first 2. You've got to do the first 2 first, and then let's simplify from there. And fortunately, we have so many different choices in funds, and they're all kinds of ETFs that are cheap, they're easy to buy, they're all of the different components. So for instance, it would be simple to have a total bond fund, but that's oversimplifying because you don't want all that stuff that's in that total bond fund. You actually want to look at that more closely and just buy the 1 or 2 things you really want out of that fund. So maybe the better solution is to have 2 treasury bond funds, intermediate and long term or something like that. But so that's the third principle. And then the fourth one I think you're referring to is the Bruce Lee principle.
That's my favorite principle. That's where Optimus Prime came from, was the fourth principle.
It's a life optimization principle. Bruce Lee basically said, whenever you're given expert material or some kind of learned material, it's better not to just take it all on and say, I like this expert, I like the cut of his jib, and say, okay, I'm just going to follow everything they do. That's really not the way you want to be approaching investing or anything in life. It's better to, what he said was, take what is useful, discard what is useless for you, and add what is uniquely your own. Which means you should never be afraid to say, I agree with this person about this idea, but not about this idea. So I'm only going to adopt this idea from this person. And then I'm going to go over to another expert and take something from them. And the kinds of portfolios I've ended up have principles from Paul Merriman, from Ray Dalio, from Bill Bengen, and Larry Swedroe. But I would not follow any one of those people just lock, stock, and barrel. I think you really need to be thinking about, what is my goal? And just because somebody's famous or popular or whatever doesn't mean you should just wholesale just adopt what they do and think that is necessarily going to work for you. because it might not, because they might have different goals.
Exactly. And actually, I want to drop in the show notes and quote Paula Pant, because you were on her show and she created for you because you don't like another job.
I like to get other people to do my work for me, Bill.
You don't like to do any work you don't want to do. So Paula Pant did some work for you. And what did she do, in case people are curious about this sequence of events, the principles, and the composition, the general composition of a diversified retirement, AKA risk parity portfolio in this case?
Okay, so this was Afford Anything, episode 618. And Paula Pant interviewed me about my history with portfolio construction, how I came to what I do. And so what she created was a blueprint, which is I think it's a 3 or 4 page document that I've cited to it on my site. But if you go to the Afford Anything podcast, number 618, you'll find, you can download it. And it's just a basic outline of the kinds of portfolios that tend to work well in retirement based on sort of basic macro allocations to stocks, bonds, and alternatives and cash. But yeah, that's been very helpful to a lot of people who are interested in this, but they don't want to listen to my podcast. Between Paula Pant's podcast, she's a professional interviewer, so she gets to the point. And I did one for Bigger Pockets that's very popular, but those are 2 good places to get an idea of what all this is about that I talk about all the time.
Well, they can actually listen to our show too, Frank, because you've been on a couple of times talking about a couple of things with this. So, yeah.
Promote your own show, Bill.
Well, we've gone on 2 hours today. This is a special double feature edition of Frank Vasquez on bonds, James Bond, and Are They Dead or Not? Frank, I'm going to turn it over to you to close out the show. You're a professional podcaster, and I can see our signals beginning to fade. So give us your last words of wisdom for our audience today who've made it 2 hours into this.
2 things I want to say, Bill. Thank you for having me on and asking me all these interesting questions. I know we've covered a lot of material and it sounds really complicated, but in the end, you're going to only need 1 or 2 bond funds probably for most people in most portfolios. And this actually is not going to be that complicated. You don't need to know everything there is to know about bonds, but you probably should know more than you're told initially. The other thing I would like to do, Bill, is promote my charity.
Please do. Perfect opportunity. Yes.
So I am now the chairman of the board of a charity called the Father McKenna Center, which serves hungry and homeless people in Washington, D.C. And it is a relatively small charity, but we have a lot of leverage and we do a lot of good work. And we have a lot of volunteers, particularly young volunteers. We're associated with a high school, and so we have a lot of high school students that volunteer there. I'm currently running a campaign that I just started in episode 518 of my podcast, which just came out, and we are raising money for the charity. I've got 2 listeners that have already put up matching funds of $25,000 to get matches for. And last year, the campaign was very successful, and I'm very grateful to everybody that donated. I have a lot of very generous listeners, but I would like you to check that out. Hopefully we'll put a link in the show notes to the donation page. If you do donate, mention Risk Parity Radio or Catching Up to FI, and we'll include it in the matching amounts there. But we'll be doing that all summer. So hopefully you'll get this by then.
Yeah, I'm a contributor to both charities, and his wife has one as well, Queen Mary, and Fairfax Casa is hers. But Father McKenna Center, I hope to actually do the walk with you this year in September, Frank. So you'll have to make sure I'm aware of the date, since I now have more time on my hands as a semi-retired ER physician. So
September 26th, Bill, September 26th.
All right, perfect time to be in DC then. All right. Well, thanks everybody for listening to us today. This will be a 2-part episode. I hope you learned a lot about bonds, and if you haven't, I hope you had a good time. Thanks again, Frank.
You know where to find me.
Yeah, for joining us on Catching Up to FI. See you next week.
Thanks, Bill.
So, Bill, as you know, we cannot do this show without our amazing staff and the people that help us put this on. And our editor is Fritz Brizard. We love them, and they keep us going.
Yeah, Jackie. I mean, this show wouldn't have the quality it has without our folks, our peeps. And we'd also like to give you a few calls to action for the show. We love our community, and we hope you love us back. If you would like to support the show and our mission to help late starters, you can do that at Buy Me a Coffee, which is a platform that allows you to make a donation. The link is in the show notes and on the website.
Check out the show notes for resources mentioned in today's show. Also, head on over to our website at catchinguptofy.com and check out our vetted resources, partners, and affiliates for discounts and their services, because we love sharing great deals.
Please share the show with others and head on over to our Facebook community to help us grow. If you prefer video, head on over to YouTube and watch the show there. We hope you've enjoyed this episode of Catching Up to Fi. We would appreciate it if you could also leave us a 5-star review to help our message reach others.
And while we are financial educators that love to teach, remember that our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
So, Jackie, we'll see our audience next time on Catching Up to Fi. Cheers.